morning, Real ECN listeners. This is your weekly FX update brought to you by Real ECN. This weekly update, we will encompass the euro-dollar market. The bull continued to dictate the narrative for the euro-dollar market over last week's trading session, which is reflective in the establishment of new lower lows and the price action of the pair. Price action in the euro-dollar market was certainly spiked on the ATR surrounding a number of high-risk opportunities such as the Eurozone CPI print to ECB press conference and the highly anticipated US non-farm payroll report. This commentary is broken down to two components. The first component that we will explore is the technical aspect of the euro-dollar market. Without a doubt, on the medium-term outlook, the euro-dollar market has been oversold. Nevertheless, this decline may continue to extend itself as the Eurozone fundamentals continue to remain weak. Analysis of a collection of technical indicators on the hourly time interval on the euro-dollar cross is suggestive of a temporary bearish market sentiment and recommends short positions on the euro. The euro-dollar cross opened today's Sydney trading session 1 pip below the established Fibonacci resistance at 1.2688, while the Fibonacci support is set at 1.2674. Since the euro-dollar correction to the downside, the pair hasn't managed to break above the 200-day simple moving average during the end of last week's trading session. Therefore, this is indicative of a long-term bearish outlook on the cross moving forward if it cannot hold above the 200-day simple moving average. This bearish standpoint is also validated on the short-term moving average front, as the pair opened today's Sydney trading session below the 5, 10, 20, and 30-day simple moving average, which is indicative of its sell recommendation on the moving average front. Moving along to the fundamental component of the euro-dollar market, last week Eurozone economic risk event certainly hasn't done its part in supporting the single currency, especially the German IFO Business Climate Index, which ticked lower at 104.7 below an expectation of 105.7 reading. Nevertheless, this week is packed for market moving risk opportunities out from the Eurozone. For instance, on Tuesday, the German retail sale month-on-month will be released, which is expected to expand by 0.5%. In addition to that, the German unemployment change is forecast to show a job loss by 2,000, with unemployment rate expected to remain unchanged at 6.7%. Eurozone CPI year-on-year is forecast to slightly grow at 0.3%. On Wednesday, the market can expect the release of German manufacturing PMI to roll in at 50.3, with the Eurozone manufacturing PMI forecast coming at 50.5. On Thursday, the highly anticipated risk event surrounding the single currency this week is the ECB's press conference following its interest rate decision. What happened during last week's ECB conference was that the bank's implementation of policy changes after its cut in its benchmark rate. In addition to that, the bank also announced its plan to purchase asset-backed securities. The market is also monitoring this week's press conference closely to gauge whether the bank will reveal further follow-up detail regarding its asset-backed security program. The implication of these dovish policy changes is an expansion on the ECB balance sheet, which acted as a key fundamental driver in recent months' euro decline. Another consideration to bear in mind is that Spanish and Italian yield continue to remain at record lows, despite leading economic indicators failing to recover. Monitoring the development of these yield curves is critical in gauging how the VIX will react, as well as the trigger point of a potential capital outflow from the Eurozone. A capital outflow from the Eurozone only worked to hurt the euro in the long run. Wrapping up this week's trading session is Friday. Eurozone service PMI forecast to come in at 52.8, while its retail month-on-month is forecast to expand by 0.1%. Moving along to the United States, the greenback has been outperforming most of its counterpart, and the strength of the greenback can compatibly be compared to the strength seen during the financial crisis. Despite volatility at record low, the demand for the greenback is being driven by the divergence in monetary policy between the Fed and the ECB. The ECB has been aggressively dovish, while the Fed has been neutral on market pricing in a change in the undertone in the near term, based on the improving U.S. economic indicators. For instance, last week Eurozone lower lows can be attributed to an upbeat in U.S. new home sales, beating expectation by coming in at 504K, when forecast was at 430K. U.S. core durable goods order month-on-month came in line with expectation at 0.7%, while initial jobless claim ticked lower at 293,000, beating a forecast of 300,000 reading. On top of that, US GDP quarter-on-quarter grew at its fastest pace at 4.6% expansion, while its GDP price index component quarter-on-quarter grew by 2.1%. This week is packed for a market risk opportunity out from the US. An upbeat reading in this indicator would only work to reinforce the conviction of the euro-dollar decline. On Monday, the market can expect the release of US pending home sale month-on-month, forecast to contract by 0.1%, followed by a core PCE price index month-on-month forecast to expand by 0.1%, which is the Fed's model of CPI expectation. US personal spending is also forecast to expand by 0.4% on month-on-month. On Tuesday, the USCB consumer confidence is expected to tick in at 92.5, while on Wednesday, the private sector will release its ADP non-farm employment change forecast to at 210K. In addition to that, the ISM manufacturing PMI is expected to read at 58.5. Wrapping up this week's trading session is the US non-farm payroll print expected to add 215,000 jobs, while its unemployment rate is forecast to remain at 6.1%, with its ISM non-manufacturing PMI expected to read at 58.5. I want to thank all our listeners for spending their time with us. Thank you, everybody.